every market cycle has different leadership. This one was led by tech, to some extent healthcare earlier in the cycle. The next cycle is going to be much more an inflation-driven cycle, led by the commodities, led by the precious metals. So, you can ride the metals through this, but they're going to get hit too in a bust. In a global bust, most assets are going to get hit. But whereas, say, the stock market might drop 80%, gold might drop 50% or 40%. So it will be a relative performer, but there's still a big hit. So the things that will hold up in the bust will be pretty much treasuries and cash. I think people always use valuation and get nervous, but frankly, valuation's never been a good indicator of a top. Certainly, we're, as I keep saying, we're 43 years into a secular bull market at all-time highs or very near all-time highs. We've been very strong since October 2022, more than doubling off of that. So it's it's understandable that valuations are higher. And with what's going on in AI, that certainly has lifted things. But if you look below that and look at a lot of other stocks, there's plenty of areas in the market that are not overvalued at all. And frankly, as I said, valuation is not a good indicator of a top anyway. So even the things that may seem a bit up on stilts, even they look like they can go a lot higher. So it's funny, but particularly on the institutional side, all the way up from October 2022, so 3 years out, we still have people with 1 foot out the door. I mean, the portfolio managers, yes, they need to be invested. Yes, they're going with the momentum when it's up. But every time things start getting a little bit negative, they get cautious again. And that's a sign that we're not near our top yet. I think time-wise, we're not that far away. Could be just a matter of months. But from the standpoint of how far this thing can still run, to me, there's just still a big wall of worry that can fuel a much higher advance.
Investors continue to obsess over Federal Reserve policy, treating each meeting as a make-or-break moment. But the bond market, not the Fed, often sets the true direction for interest rates. Current yield patterns suggest a meaningful decline ahead, potentially taking the 10-year Treasury toward the 3% range within months, a shift that would act as fuel for risk assets. Fears that delaying a rate cut could abruptly end the rally overlook a larger truth. Liquidity trends matter far more than single policy decisions. As long as financial conditions ease, even gradually, markets can continue rising despite widespread skepticism and debate.
Now, some of the concern in the markets and also the precious metal markets, it seems like stemmed from this idea that the Fed might not cut rates in December. Your perspective on that, and how is Fed policy here going to dictate what the markets do next?
Yeah, no question. The Fed seems to be, along with the worry about an AI bubble, the Fed seems to be, right front and center in terms of the thing everybody's most concerned about. It's funny because on one hand, I think the Fed is going to help fuel this run to the top, and I still think there's 40% plus to go. But on the other hand, it doesn't mean it has to, that if they don't cut in December, it's all over. I mean, people get a little too obsessed with the Fed, frankly, and maybe even our president is doing that. But as I say, the bond market will dictate rates, and my look at the bond market tells me there's a big decline in rates coming. Doesn't mean it's right from here, but I think somewhere between we're 410 or thereabouts, between 410 and 420 on the 10-year. Is, I think, the end of this backup in rates, and I think you'll see 3% probably in a matter of a few months.
After a long buildup, precious metals are finally showing synchronized strength. Gold recently pushed to record levels, while silver, long the laggard, has surged sharply as investors recognize tightening supply. Mining stocks, which often lead major moves, appear to be stabilizing after a broad correction, hinting that a new leg upward may be forming. Despite some analysts calling for further downside, historical inflection points in metals typically occur when sentiment is most divided. With silver and gold both hovering near all-time highs and global demand rising, the probability of a strong multi-month advance is increasing, particularly for miners, which remain deeply leveraged to price gains.
It's been a tremendous run this year. The miners have finally started to catch up to the metals. Gold's done very well, as we know. Has been up to 4,400, I think. And silver, which had lagged, has done a lot of catch up in the last several months. We've gone through a correction here. You got a lot of people calling for lower prices on gold and silver, lower prices on the metals. My look at it is that we are at that inflection point here too. I think as of yesterday, today, you may have bottomed out in the miners, and I think there's a big run ahead. I think the biggest part of the run in the miners is ahead. As big as some of those have doubled and tripled off their bottom, some more than that. And yet I still think the biggest move is ahead of us, and ahead of us in the next 6 months. It's not, 2 years ahead, 3 years ahead. They will get hit in a global bust, which is what I'm expecting after this, sometime next year. But before that, there's big upside in the miners. My target on gold, was 5,000. That's but I think that may prove conservative. I raised my target back in early October in my fourth quarter letter on silver. I raised that to $100 from 75. And I'm pretty confident we're going to see that in the next, several months. So there's basically silver took a while to get to new highs, but it's finally at all-time highs, as well as gold. And I think now there's clear sailing for both of them.
We may be entering the last stretch of one of the longest secular bull markets in history. Projections for the major indexes point toward dramatic upside. The S&P 500 potentially reaching 9,500, the Nasdaq targeting 32,000, and the Dow aiming for $65,000. Such gains would represent roughly 40% from current levels, possible within months, not years. Yet the signs of a true market top are not present. Sentiment remains cautious, money managers remain defensive, and investors are far from euphoric. Only when confidence becomes unanimous and the narrative shifts to the Fed will keep this rally going for years will the final topping conditions emerge.
Yeah, so just to kind of clarify, I am looking for a top in a 43-year secular bull market. So this is what would be categorized as a very major top. And one that will probably stand for decades. So the highs in this stock market I'm calling for, which I kind of glossed over, but I'm calling for 9,500 now for the S&P. I think last time we talked, I was down at 8,700. So I've raised that in my fourth quarter letter to 9,500. That's a long way from here. It's 40%, probably from here, basically. And the Nasdaq I raised to 32,000. The Russell I raised to 3,800. And the Dow I raised to 65,000. So all of them have basically 40% plus returns from here to go. With that in mind, it's not a top yet, and even though it can come very fast in this final stage, you don't want to get nervous yet and jump out. But on the other hand, time-wise, we could be at a top as early as sometime in the first quarter. And so you do have to start looking. And what I will say is that we're not seeing the signs here yet, but what I would be looking for is sentiment to be all in. Once you have, as I said, people are pretty cautious right now, and every time we get a little sell-off, they get nervous. Once you have everybody convinced, we got the Fed at our back, the Fed's getting more aggressive in easing. It means the cycle has a long ways to go. It could last for a couple more years. Once you start hearing that rhetoric, that's the beginning of the end. It's not the end, but it's the beginning of having to start say, how long can this run? I don't think it has 2 years to run. I think it has months to run. I may be wrong. It may get stretched out again. But that's what I would be looking for, is sentiment to move from this kind of semi-bearish, cautious area to where everybody's convinced that everything's wonderful. And I think that's coming. It's that kind of what we see at tops. We haven't seen that in this cycle yet. I also think that you'll begin to see a much weaker economy. And that's, I think, will help fuel this last run, is as the economy weakens, the Fed's going to get more aggressive on the easing side. They have to start pumping liquidity because they've been too restrictive. And that will initially be taken as a positive for the market. But as the economy continues to weaken, I don't think the Fed's going to be easing aggressively enough to stop what I think is going to be a pretty dire 2026. So that's what I would start thinking about. And you mentioned market timing. Again, I've talked about this in a few of my interviews. From the mid 80s on, the mantra in terms of what the financial industry pushes on the investor is it's time in the market, not timing the market. I would just caution people, that has been great advice. Anybody that just kept putting money into an index fund for the last 30, 40 years has been very thankful of that, and just stayed with it, has made a lot of money. There comes a time when a big cycle comes to an end. I'm not talking about the shorter economic cycles, but a bigger market cycle comes to an end. And when it does, and if I'm right that this one's going to be a major top where you could see as much as an 80% decline in the stock market, you don't want to ride that down. So even though, the advice of just buy and hold and markets always go to new highs has worked wonderfully for 40 years, is not going to work well for the next decade, because you're going to get hit very hard if this thing does what I think it's going to do. And then you're going to have to dig yourself out of a big hole, and you may not get back to the levels you were at this year or early next year. So it is a time when you may have to kind of go against what's conventional wisdom right now in terms of buy and hold, and say, I'm going to be out. It doesn't mean you have to be perfect and when you get out, but you're going to have a better entry point, I think, probably end of next year or early 2027. And it will be a different market cycle following this one. Every market cycle has different leadership. This one was led by tech, to some extent healthcare earlier in the cycle. The next cycle is going to be much more an inflation-driven cycle, led by the commodities, led by the precious metals. So, you can ride the metals through this, but they're going to get hit too in a bust. In a global bust, most assets are going to get hit. But whereas, say, the stock market might drop 80%, gold might drop 50% or 40%. So it will be a relative performer, but there's still a big hit. So the things that will hold up in the bust will be pretty much treasuries and cash.
Ironically, a weakening economy may provide the last burst of fuel for equities. As growth softens, the Federal Reserve would be pressured to increase liquidity, which markets often celebrate, at least initially. But this enthusiasm can mask deeper structural fragilities. If the projected topping pattern plays out, 2026 could mark the start of a significant global downturn, potentially triggering an 80% drawdown in major indexes. Traditional time-in-the-market strategies that worked for decades could backfire in such an environment. When supercycles end, the recovery often takes years, leaving long-term investors trapped far below previous highs.
It seems like the people holding kind of the traditional portfolio, I guess there's bonds in there, right? So those might not do terribly if they have treasuries, but it seems like the general public is really ill prepared for what's coming, is what you're saying.
Yeah, because it's a strategy that's worked for so long has gained a lot of acceptance. So it's going to take a real mindset change to go from, well, I just let my portfolio ride because it always comes back. Yes, we have these periods of time that are negative, but I'm not smart enough to time it, so I'm just going to stay put. That's been the conventional wisdom for a long time now. It's going to be very hard to convince people to go against that because it's worked so well. And yet that's probably what they should do.
Every major market cycle births new leaders. Technology dominated the last era, but the next is likely to favor commodities and precious metals, supported by structural shortages and long-term inflationary forces. Even so, during a global bust, nearly all risk assets decline, gold included, though metals typically fall far less than stocks. The only assets that historically hold up are high-quality bonds and cash. Yet most investors remain conditioned by decades of buy-and-hold success, unprepared for a period that may require decisive repositioning. The coming years may demand one of the hardest shifts of all, abandoning strategies that have worked flawlessly for a generation.